Let's welcome our market master for the day. Jyotivardhan Jaipuria, the head of research at Bank of America Merrill Lynch, is our master. Jyoti, the markets are in a very cheerful spot. It's 1% higher, both for the Sensex and the Nifty, and a 1.2% gain for the mid-caps. The advanced declines are so roaringly in favor of advances. It's almost 9 stocks in the green for 1 in the red. So 90% of the market is higher than where we left it yesterday at close. Extremely good going, at least as of now. Good morning, Jyoti. What's the sense about the markets in 2015 first? Since you are a longer-term watcher, not for the short term. Do you think after putting on 30-35% weight, we can do much in the coming year?
Okay, so we still expect positive returns for 2015, but yeah, lower than what we've had this year, because this year has been like a great year. So I think we will get around 15% returns further in 2015, which I think would be very good.
Okay, well, the government is actually leading on to a fairly fruitful winter session. The GST bill has at least cleared the cabinet as a hurdle. It perhaps has a year and more to get all the states on board, and even for that matter, the Rajya Sabha on board. As well, they seem to have made some tardy progress on things like the insurance bill, the companies bill. Do you think these incremental acts of the government can give it a much tidier, can give the markets a much tidier rise in 2015? I mean, they are at it. Would that be the interpretation of the market?
Yeah, so I guess when we are positive on the market, we are looking at reforms moving ahead, though not really at some big bang pace, but reform moving ahead, and government doing one by one some bills which go ahead and help the whole recovery process. The other thing is that you have margins which are at 18-year lows. You have the economy which is at a low point. It will slowly start to recover, because if you look at the big macro, your current account deficit stress, your inflation stress, a lot of those stresses are going away. So to that extent, at some point during the course of the year, it would start translating into better recovery coming through in the economy.
Okay. Hi, Jyoti. Good morning. The big cue for today will be the mid-year economic review that is expected to be around 12 o'clock. Do you expect any tweaking in the growth assumptions or even in the fiscal deficit target that's laid out for this year? What can we expect?
Yeah, I don't think they'll change the fiscal deficit target, which they put at 4.1. Even when the finance minister laid it out, he said it would be a tough target. He's setting himself a tough target to achieve. And I think, if you think of what he's been doing, there have been, expenditure cuts which he's announced over the last few weeks. So that, I think, is an intention that he intends to meet the target. Really, there are some holes. Oil has provided him some buffer, really. He has to meet his divestment target, so that is something which has been moving slowly. But my guess is they'll aim for it in the first quarter of next year, where they'll do some big ticket companies and meet the target.
Okay, well, Jyoti, what about earnings? That piece has not quite clearly bounced. Do you see that happening in the third quarter? I mean, when the January numbers come, do we have to wait for it for the fourth quarter? What are the numbers you're working with for 15 and for 16?
Yes, we have a thesis that earnings will double over 4 years. Okay. But, it will be back-ended rather than front-ended. So we are not looking at FY15 or 16 being like the greatest years. It's probably FY17, which we think will be close to a 25% growth year. Okay. But in FY15, we are looking at around 15% earnings growth. My guess is, the third quarter is not going to be a very good quarter, because two things will happen. One is, there will be inventory losses for a lot of people. You've had these oil prices come down, which ultimately will benefit a lot of companies. But in the first part of it, you'll be faced with inventory losses. So probably expect that inventory losses. There are companies which have come and guided lower in the last 10 days. We've seen 2-3 such companies. So demand has not really picked up. Demand has been weak and sluggish. And to that extent, I don't think it's going to be a great quarter. Just remember, even the September quarter was not a great quarter. Aggregate earnings growth for the Sensex companies was under 10%, which probably was the weakest in the last 5 quarters.
You gave me the FY15 number, 15% earnings growth. FY17, you said 25. 16?
16, we are looking at something like 17% earnings growth.
Okay. Let's get in our query, which is posted on our money control message board, Jyoti. It's Vikas who's written to us from Wardha in Maharashtra. He wants to know if it is a good time to invest in metal stocks. And I think that would be an overriding query, because we've seen a big correction in most of the metal stocks. They've lost more than 20%. Do you think the situation is now stabilized and they offer an attractive entry point? On which ones, if you could recommend?
Yeah, basically, we've been bearish on metals for the last 2 years, and we continue to be bearish. There is a case that, these stocks have done very badly, so to that extent, they're not expensive. But our overriding concern is that China is going to slow down. We're not going to see the sort of investment boom that we saw in China over the last many years. To that extent, the super cycle in commodities is over, which, in macro-wise is a good news for India, but to that extent, it hurts the metal stocks. And that's been like our overall thesis, that you'll probably get bounces in these stocks, but these are not stocks which will make you money over a long period of time. So best to remain underweight in these stocks.
Okay. Well, I'll come to China once again, time permitting. But what's your take on crude? I mean, you're almost a veteran watcher of the petrochemical space as well, I would assume, the upstream. So what's the view on crude, and are we playing it in India correctly? Invariably what comes to the mind are the crude and the crude derivatives companies. We look at the oil companies, we look at probably tire or some of those synthetic rubber users or paints. Isn't there an overall earnings uptick that can come from energy, cheaper fuels?
Yeah, so like all said and done on crude, I don't think people ever get this right. So that's my 3 months back, nobody would have forecast that we are going to $60 on crude. So we should be happy the way it is. Hopefully it continues somewhere around these levels. And I think, more than specific companies, it's just great for the macro. So what it does is it takes away your fears of inflation, it takes away your fears of current account deficit, and then it provides some room for the RBI to start cutting rates, because if structurally crude remains low, then you probably just go down structurally on inflation. So I think the big thing is, like, we get interest rates coming back, and interest rates probably are cut more aggressively than they would be if crude was at $100, which it used to trade a few weeks ago. And so, the gainers are a whole set of companies. It just helps economic revival. It helps interest rate sensitive companies. Apart from that, like you said, there are a few companies which use crude and they are direct beneficiaries. And there one has to see what the demand environment is, because if the demand environment is weak, you end up passing on a lot of the benefit you get from the raw material prices falling. But if the demand environment is strong, then they can keep that and make money.
Okay. How do you read the conflicting commentary that we've got from IT companies? TCS sounded cautious, but on the other hand, Accenture went ahead and upped their FY15 guidance. What's the call on IT now? And is there a case that TCS perhaps might underperform its peers or not? The problem might be TCS specific?
Okay, so on IT we are neutral. We're not overweight, we are not underweight. And the reason has been that these stocks don't look very expensive. They've underperformed for the whole of this year. To that extent, there's some value in them. At the same time, we don't think they are going to really outperform the market in terms of their earnings growth. So you love these stocks when they were doing much, much better. Earnings growth in India was very weak. In an environment where we think earnings growth will pick up, these companies will probably keep doing what it used to do in the past. They'll keep growing at that 15-odd%. But now there are lots of companies which used to grow much lower but will start growing more than 15%. So we are neutralish on them. It's, if the rupee is volatile, then this is one place where people can, get some exposure to the rupee and be a little safe. But otherwise, we don't think it's going to be a great outperforming sector for the long period.
You spoke about metal stocks not likely to have a great time for the next 1 year at least because of the Chinese slowing. That would affect all commodity stocks, you think? I mean, the petrochemicals, anybody who is a resource processor?
Yeah, so in general, like we've been avoiding global commodities because of this fear that China, it's not just that China won't grow, but what they're trying to do is grow consumption rather than investment. So they probably have the reverse problem from what we have. They want to grow investment and slow down grow consumption and slow down investments.
Yep.
We're trying to do the reverse of that. So that's the reason that if you are slowing down investment, then all the drivers which, basically drove global commodity prices are going to slow down.
Okay. Jyoti, what about, the leaders in the Nifty? You're reasonably confident that the Nifty can put on weight next year. What would be the leaders?
We are looking at, I would say, domestic companies which will do well. So our overweights are the auto companies, which of course, have done well this year also. We like the banks. And in fact, the new thing is we've been positive on public sector banks this year, which we typically have not been for the last many years. We are positive on cement. So these are, three of our biggest overweight sectors.
Okay, actually a lot of the foreign brokerages still avoid the PSU banks. Why you positive?
PSU banks for me is like a tactical play. Two things happen. One is as the economy recovers, the PSU banks probably benefit in some sense more than the private sector banks because, their NPLs are much worse than what the private sector banks are. In a recovery, you start seeing NPLs worries start to ease off, and that is what will benefit the public sector banks. Second is as interest rates get cut and bonds start to do well, the PSU banks typically are more exposed to bonds than the private sector banks are.
Okay.
So it's a play which is probably a more tactical play.
Okay, Jyoti, it's always a pleasure to get you in here and get your views. Thanks as always for joining in.